Okay, individual retirement plans. Just want to dispel the misnomer that people, you can do basically what happens for you in a 401k, you can do it yourself and create your own IRA. You do not have to have a company do an individual retirement account for you. You can do it yourself. Pretty much any bank or any investment platform, you can create it yourself. This is what you need to understand. There are traditional IRAs which defer your taxes until you withdraw the money for retirement. And I'm gonna say the definitions and I'm gonna go back and explain a little bit deeper. Roth IRAs, you contribute after tax income, but withdraw your taxes free. That means you go ahead and pay the government. I stopped calling him Uncle Sam because he's my uncle. You pay the government all that they're due up front, and then so then when you withdraw your money, you've already paid the government theirs, and they only get your earned interest return. With the traditional, they reduce. So if I make $1,500 a month, and I put money into, let's say $500 a month into my retirement, I'm basically reporting that I made $12,000 a year. Well, I have $12,000 of taxable income versus the $18,000. So you're gonna pay taxes on a lesser amount, but they're like, yeah, go ahead, keep your money, because that means you're investing and it's gonna grow. And then when you're ready to take it out, we want to cut a bigger pie. So that's the decision that you have to make. Yeah, it benefits the government in terms of collection, but where you have to decide is, what is the tax break that I need today? Like, is it worth it to me? So I always encourage people to do both so that you can manage your tax strategy in alignment with your retirement goals. So for instance, if you go to taxtips.net, you have to look at, yes, write that down, taxtips.net. So what it will tell you, if you're single, filing single, you're married, filing jointly, married, filing single, all the options, head of household, all of that. It will tell you if you make X amount of dollars, you're going to be taxed this percentage. And then for any amount that you make above this percentage, you're going to be taxed another percentage on top of that, right? So there's a base amount, and then there's an additional amount based on how much money you make above the base. You need to know, if you're working a second job, you're getting a promotion, if it kicks you into another tax bracket, do I need to, if I put more money in now a traditional IRA and I get my income, my taxable income down back under there so I'm not in the next tax bracket, that might be a good strategy for you. If not, then it's better to put your money in a Roth. You also have to think about, while you're in a lower earning capacity, when you can contribute into a Roth, you would want to, because there is a max. So if you make more than, and I would have to Google it because it changes every year, but I'm just going to say, if you make more than $195,000 a year, then you cannot contribute into a Roth. So when somebody puts a cap on something and the government are like, why are you putting a cap on it? I want to know why. Because it's typically, that means it's something beneficial for you if they're going to put a cap on it. So that's what made me go laser focused in our Roth IRAs. So based on your tax situation, if you have both, then you can decide, I'm going to put money here versus here. You may increase it or decrease it depending on your tax situation. This also bodes well when it's time for you to collect Social Security. Because if you are eligible for Social Security at 62 and you still work, there are like all these little caveats about if you make X amount of money, your Social Security taxed or not taxed, and all these things. And you really need to have a good tax advisor that can walk you through all your tax scenarios so that you're always making good decisions. I had to learn the hard way, get a good tax person. So understanding those things helps you know what levers to push and pull and when, and the amounts to put in when and when. Because if it says when you retire, when you collect Social Security, if your taxable income is this, then you get this without taxing by this age. And y'all, there's a lot of boxes to check. So I just need you to know, like, it is something that you need to pay attention to. X, Y, Z, then you need to do A. Like, I don't know if y'all did geometry. This is why geometry was important, because it's, or the algebra. So you think algebra will work, and it does. So when you do A, B, and C, you got to know what is X so that I can do Y. So that's the kind of the strategy that you need to employ to maximize your income in retirement. You have to know all those levers. Okay? Yes. So really quick for the IRAs, there's SEP IRAs and simple IRAs, and those are based on whether you are a small business owner or not. So those are the opportunities you have there for the same experience. Were you got someone else say something?
I was going to say I have a SEP, small business owner.
Yeah. They operate the same, just a different name. SEP stands for, I think, simple IRAs and then SEP IRAs, but they operate the same as a traditional, but they're just for small businesses versus Roth. Yes.
You mentioned with the Roth IRA, what was that amount? Like you said, if you make a certain amount, you're not, or over that amount, you're not able to contribute. Is that like for couple, or is it?
So they have two numbers. So the numbers, and I actually would have to Google it, and I don't want to give you the wrong number. You can sit there actually on your phone and Google it, like what is the maximum income that you can make to contribute to a Roth IRA. And they give you a number as a single individual, and they give you a number as a couple.
Is there no max on the traditional IRA?
There's on the traditional, no, because you're paying taxes.
When it's
After.
Okay.
Yeah, you're paying, it's after tax. So simple, you're having that benefit. Basically, you're saying to the government, I'm paying my taxes up front. And so it kicks you into a different system too. I'm glad you brought that up, because when you do start to pull money from your IRA, you can pull it. You don't have to pull your money. So you can start pulling your money out on these tax sheltered retirement, because that's the whole point of an IRA, is to create a tax shelter. So so these investment accounts basically give you preferred tax options because you say you're going to use this money for retirement. Now, when you invest outside of an IRA and you do straight investments, that's additional income that you have to report, and it's just like your W-2 income or your business income. So all IRAs do is give you a tax shelter and give you options to manage your taxes. So to that point, at 59 and a half, that's when you can pull your money out of these individual retirement accounts without a penalty. And then when you pull your money out, if you are in a traditional IRA, that's when you get taxed on that money as income. If you're in a Roth, you don't get you only pay taxes on the growth, not on the money that you put in, because you already paid taxes on that money. Now, if you hold off and say with the traditional IRA, remember the government's been waiting for your money for a very long time. You haven't paid any money on those taxes. So they say, if you're not just going to be able to pass this money on to your kids. No. So when you're 70, you have a required minimum distribution. So they're going to say, you can't just hoard this money and not pay us any taxes on it. So if you haven't pulled any money out, we're going to tell you exactly how much you have to pull out so that we can start to get some tax money off of it. And that's called a required minimum distribution. Okay? So that also is something that you have to factor in when you're thinking about your streams of income and where that lands you on the income spectrum. Okay? And I think that was in alignment with your question. Okay, so we talked about 401ks already. So unless y'all have, and you have the same options. So 401ks are provided by the company. They usually do that in lieu of pensions or in addition to pensions. You can typically choose between a Roth 401k or a traditional 401k. The only difference from a 401k and an IRA is that a company is sponsoring it, and they typically get to pick the fund manager. So they usually give you, they tell you whoever's the manager is, they'll sit down with you and say, well, these are the companies we invest in, and you can look them up on the website, but you don't have any control really on what companies they invest in. However, you can pick the strategy. So the strategy ends up being, do you want to be conservative? And they'll tell you all the different options for conservative, like a mix of bonds and cash equivalents, or moderate, which gives you another mix, and you have to determine what you're comfortable with. So it's the less risky of the stocks, but you're starting to invest in major corporations. And then if you are doing more aggressive investing, it's usually small cap companies that have greater fluctuations. They make a lot of money, but you got to watch them because they also can go out of business and lose a lot of money. So it has greater fluctuations, but usually an average return over time, like that 20-year period, is usually higher, usually a lot higher than in moderate. But you just have to understand that you can't, it is just not as advantageous to be in aggressive investments the closer you get to retirement. So those are the differences that you're making. Now, there's also an option that you can pick where it automatically, because you may not be on top of things, or I just don't have time to do all of this. So you may say, okay, I'm planning on retiring at 60. It's 50 now. I need to reallocate my distribution. So you may say, I want 25% to be conservative in bonds. I want 50% to be moderate, and I want 25% to be aggressive. And then you say, okay, I'm about to retire in 10 years. I want to pull that back a little bit. I'll leave 10% in aggressive, and I want to do 50% in moderate, and I want to do 60%. I don't know if my percentage is adding up now in conservative. But you would have to tell them to do that, or you can pick this option that says that it will automatically do that for you. You just tell the advisor, this is the year that I plan to retire. So usually your funds will be called, if you say I'm going to retire in 2050, then your fund is going to be called 2050 fund, because it's saying she's planning on using this money at 2050. Therefore, we're going to automatically shift the investment strategy based on her retiring. So they kind of put it on a system for you, so you don't have to do it yourself. Okay? So those are some, this is why you have to know these terms, because these are decisions that you need to make versus, and these are the questions people need to ask you. And if they're not asking you these questions, then they're making decisions for you, lumping you in a category and doing what they want to do. Okay? And you need to be making those decisions for yourself. Any questions? 403B is pretty much very similar, but it's, again, the government version of a 401k. Okay? Looking at your faces, just making sure I don't see any questions on your faces. So pros and cons, very quickly. When you open an IRA, the benefit is you can choose to invest in a wide range of financial products, including stocks, bonds, ETFs, and mutual funds, exchange-traded funds. The downside is your money is held in an IRA. It usually cannot be drawn until you're 59 and a half without incurring a hefty tax penalty and 10% of the amount drawn. The benefit of a 401k, it lets you reduce your tax burden while you're saving for retirement. Not only do you get tax deferred gains, but it's also hassle-free since contributions are automatically subtracted from your paycheck. Many employers will match part of your employee's 401k contributions. It's called free money. I always give people, how much are they matching? Get it all. It's free money. And then it gives you basically a free boost. The downside, in recent decades, 401k plans have become more common and traditional pensions have become rare as employers have shifted the responsibility of risk to saving for retirement from themselves to the employees. 403B, earnings and returns and rate the upside. They're tax deferred until drawn. They're not subject to certain requirements that lower the administrative costs. which will, because there are administrative costs in your plans that can affect your return. So having that reduced is important. Many 403B plans over a shorter period of time allow for immediate vesting, meaning that they will tell you if you're vested, that means that even if you leave, you still get the benefit of that fund and they will keep it and manage it for you. Employees with 15 or more years of service may be increased to eligible for an increased catch-up contribution, as pointed out earlier. The downside is some plans may offer a narrow choice of investments. Accounts within a 403B may lack the same protection from creditors as with ERISA requirements, and non-ERISA 403Bs are exempt from non-discrimination testing. So non-discrimination testing just makes sure that whoever's managing the plan doesn't make decisions based on who you are, your age, gender, sexual orientation, all that. There are tests for that. So basically, it's you deciding what's best for you.